I'm indifferent about the dollar. It's you look at the versus the Dixie, which is mostly Europe. You look at the trade weighted broad dollar. It's basically in the middle of the range it's been in for the last 5 years. And as Anna mentioned, there's a good reason, I guess, for it to pull back a little bit. But the key thing to remember about the dollar against a broad measure of currencies, it only goes down after it goes up a lot, and it went up a lot into the massive Federal Reserve and fiscal stimulus and monetary stimulus we had into that peak in 2021. Now it's coming back. I don't know how much lower it goes, but in terms of, I do enjoy when people equate it directly to Bitcoin. It's a small factor, and I think the actual price of Bitcoin now in the gold and copper, it's a much more significant factor, much more established commodities that are basically the inversion of the dollar.
All 106 economists surveyed by Reuters predict that the U.S. Federal Reserve will increase its benchmark overnight interest rate by 25 basis points to the 5.25% to 5.5% range on July 26. The majority of them continue to believe that this will be the final hike of the current tightening cycle. Analysts and investors have been continually baffled by a strong economy and record low unemployment well over a year after the Fed started one of its most aggressive rate hike campaigns in history. As a result of the headline Consumer Price Index, CPI, measures slowed down to 3% in June from 4% in May, inflation is declining. This has caused many Wall Street analysts to infer that inflation may soon be tamed, and some have renewed wagers that rate cuts may occur as soon as the end of 2023. Whether additional rate rises are essential to ensure that there is no inflation or whether doing so could harm the economy unnecessarily, is the topic of the present discussion. As Mike McGlone discusses rate increases, inflation, and other economic indicators, we will now join him. Don't forget to hit the subscribe button, like the video, and leave comments below.
Market expectations. You look at the WIRP function on the Bloomberg terminal, it says 92% that they're going to raise another hike on July 26th, and they're going to keep raising, and we're not going to get a cut until March. Now, this is what a lot of economists think, but it doesn't matter so much when the market's already priced for it. So I look at it, it's still simply a fact is the market, the Fed is still taking away liquidity, and most risk assets are expensive, completely expecting this soft landing. And the whole narrative is termed that, oh, we're not going to get a recession. The Fed's still tightening. Everything's okay. I look at this as one of the most offside markets in history, and the risk reward is just not good. And so if my scenario kicks in, which I still think it's going to, with we'll let Anna comment on this. You get the normal reciprocity from all this tightening, and it shows up in the economy, but in a delayed reaction. Bitcoin should want to be the first ones to show it. So right now, the Fed is still going to keep tightening, and what's going to keep them tightening is the stock market keeps going up. It's still that same issue, which is a problem. Then I look over at Bitcoin as, yes, I'd love to be bullish Bitcoin, but if you look at that price right now at 30,000, the first time it traded 30,000 was right at the end of 2020, right at the beginning of 2021. And if you look, so it's unchanged. You look at the NASDAQ over the same period, it's up 20%, yet the volatility in NASDAQ is half that of Bitcoin. So right now, yeah, Bitcoin's great. It's got all this ETFs coming on. We have the hopium for the ETF. But if the actual performance versus the NASDAQ, which has got AI and everything going for it, I look at it as I'm disappointed. And I think it's still the problem is I sense so much bullishness. But yet the macro is very unfavorable. The Fed is still taking away the punch bowl. Because I had to bring up some charts and things I've been focusing on for a while. And that's, first of all, let's start with U.S. new homes under construction. It's the highest ever. I go back to 1969 on this one. And the chart looks just like it did in 2006-07. It double topped and then collapsed. The big difference was back then as the Fed started easing in September 2007. Big difference. And also we have this massive spike in interest rates. Yes, we're freezing up the sell side for people who do not want to sell their home and refinance at a higher rate. But since when is seizing up a market good for it? And another chart it may bring up is we just look at producer price indexes, the year-over-year measure. It's at minus 3%. It's only happened 3 times in history since 1949. This is the finished goods measure. And it's never happened with the Fed funds rate still rising at, I'm just using a 3-month bill at 5.28% at the moment. This has never happened before. And I look at it as, okay, maybe the whole rules of all the lessons of economics and liquidity and cycles are no longer accurate, which is what I've been doing on my vacation. I've been really enjoying reading and relearning all this financial history stuff I forget on a daily basis. Those are accidents just waiting to happen. Now, PPI at minus 3% is probably bottoming soon. But the fact that the Fed is still tightening the environment, now we see China, every single piece of data out of China is disappointment. That's a train wreck just getting started. So I look at this is the macro. I'm an impatient person, and market's testing my impatience. But these things take a while. Let's look at the facts. They started dropping the required reserve rate about a decade ago. It's been dropping ever since. They've been pumping liquidity forever. Now we have a housing crisis that's kicking in, and unemployment, and on and nose. We hear from my colleagues who are based there, they have to be careful because this is the situation now is you can't put your name into an article on China if you don't want to risk imprisonment. And that's just that's the fact. So we're at that stage now. It looks to me, China to me is a combination of peak Japan and peak Soviet Union about 3 decades ago. It's all tilting that way. Quick question I ask is, what changes this current trajectory of disappointment? They have to stimulate, yet they know they can't stimulate much anymore. Locals, I hear the local entities are so over indebted, they have issues. And of course, the housing crisis looks like it's just getting started. Everybody said, I think we can all put together. I definitely agree with Dave about the optionality of Bitcoin and digital gold. And remember, I made the call for 100,000 Bitcoin when it was trading below 20, and we got that in Ethereum. And then, of course, what happened with China. And I still stick with that in the long term, but I think it's more likely to drop 50% and get down to 20, even make a new low before it goes on that trajectory, particularly when I see things like, well, I can get 5 1/4 in a T-bill, done. I look at the Case-Shiller index, the housing index, it just was almost at the highest ever right before, like 2006, up 20%. Now it's down 1%. That's collapsing. I look at the Fed still tightening. And the last thing that always usually falls is the stock market. Just look at your history. I remember 2006 and 7 was tough, just like Big Short. I was short a lot of stuff and I didn't get paid back until 2008. It's just the way it works and people get stopped up. But there's two things. One thing I want to mention is what's happening with Case-Shiller. Bitcoin, I completely agree, but it has major competition like gold does from the US, the base currency giving you the best rate on the planet and the deepest treasury market. But there's one thing I also want to mention I really enjoyed recently to point out how significant this technology is. We're hearing about Hong Kong maybe lightening up a little bit of their strict regulations, and I heard they might approve a Hong Kong crypto dollar. The Hong Kong dollar is pegged to the US dollar, which means that's a quasi crypto dollar.
Dollar stablecoin. So is the Chinese yuan, right?
But
so is the digital yuan.
Exactly. It shows how significant this technology has adapted to the US system, to the dollar, organically. And it's for the US not to mess it up. And I think the updated Lummis Gillibrand bill is going to show that they're not going to mess it up. But it just shows that you can't overweight them. So I just double checked. I always love to check the volume. I show this to everyone. If you check on coinmarketcap.com and click on volume, Tether's always number one. You love it or hate it, but I've seen that since 2018 in Hong Kong. They pointed it out to me. You will see the stock market drop 50% and stay down and not make a high for 10, 20 years. It always happens, and always happens after the biggest pumps in liquidity, which we've had. It could take a new high, but I love hearing traders have traded for 10 years. I've been trading for 10 years. Like, you need to trade for 30 years. And this is Dave. I knew Dave would laugh because we've seen this before, and I've seen it. It's the narrative I've seen. It's usually the psychology. When you hear people, when people tell you, oh, well, when you just express something rational and optimistic about how markets work, and they say things like, well, feel great being poor. And then you look at yourself. I remember hearing that in the 80s, in 87. I remember hearing it in 2000. I remember hearing 2006. And the key thing I'm really worried about now, and with this, is there's so much bullishness, even from Larry Fink, who has a vested interest in pushing a product to track Bitcoin right now, that I have to push back and say, good luck with that one. T-bills look great. And yes, we've seen this before.
14 out of 23 experts who responded to the supplementary question said wage inflation would be the most sticky part of core inflation. 27 out of 41 respondents, or little under 2/3, predicted a U.S. recession within the following year, with 85% of them predicting it will begin in 2023. Nevertheless, the economy was forecast to expand by 1.5% this year, up from the 1.2% forecasted a month earlier, and then moderate to 0.7% the next year. What do you anticipate the economy will look like at the conclusion of the year? Tell us in the comments section below. Don't forget to subscribe, hit the like button, and turn on notifications. Thank you for watching.